How is everyone doing? I hope you are well. Let's go ahead and get right into it. Bankruptcies are up. World War III looks like it's becoming closer, coming closer and closer here. Unfortunately, I don't like to come on here and be right about these things, but we warned this way, way back that when economies approach the end game and when the lifeblood of the U.S. economy, which is the U.S. consumer, uh, gets to the almost the breaking point. I mean, some people are beyond the breaking point. If you look at the bankruptcies, we'll talk about that here in just a few minutes. But when the economy slash the U.S. consumer gets closer to the breaking point, we typically see war break out. And there's a lot of different reasons for that. I'm not a geopolitical channel. I won't get into that too much. But we do know that when all else fails, it's time to go to war. And what does war do? Well, basically, the war, any sort of war, conflict, or threat can justify more money printing, more spending. There's a lot of people that get very wealthy during times of war. We're talking about the weapons manufacturers, the defense contractors, and of course, all the insiders that are connected and know exactly what's going to happen well in advance. Now, we told you here that this was going to be happening in the fourth quarter of 2023. Unfortunately, here we are. And again, I don't like to be right about these things, but I've got to say it because this is true. Things are going to get a lot worse. You haven't seen anything yet. The global conflicts are going to get much, much worse. And we've got a divide right now in the world that we've never seen before. We've got so many different things happening from a financial front, from a political front. First of all, let's just talk about the BRICS nations going outside of the US dollar. Just 5 or 10 years ago, that would have been unheard of, and that would have been considered an act of war against the United States. The United States has been very, let me try to pick the right word here, not to offend anybody. We've been very aggressive in our stance to defend the use of the US dollar, aka the petrodollar. Now there's too many countries out there going outside of the dollar to try to go up against. Now we've got things happening over in Israel. We already see what's happening and what's been happening since February of 2023 over in Russia, what's happening between the countries there. And it's just going to get worse. And why isn't the stock market crashing? Well, does the stock market and our investors eyeing maybe more easy money, maybe more rate cuts? Because now, with the conflicts that are expanding, maybe there'll be an excuse here to do emergency rate cuts, and that way, they'll be basically justified. So we'll have to see, but I think the markets do see some optimism. We've got a Fed rate decision coming up here in the very near future. I think it's going to be another pause scenario. I think the Fed's kind of frozen right now. Um, Not really sure. I think they are not really sure the direction to take because more tightening actually puts more pain and pinches the U.S. consumer even worse than we already are. But let's go ahead and get into the financial aspect of this here, starting with bankruptcies. Bankruptcies are up a decent amount this year. It's not an explosion. They haven't doubled or tripled. But let's go to an article right here. Now, we already know how bad corporate bankruptcies are, but personal bankruptcies are also up. And this was as of May, was up 20% year over year. So obviously the U.S. consumer is not doing too well. If we look at more recent numbers, some of these other reports say we're up 10%. Now, some of them don't count Chapter 11s. They only count Chapter 7. So let's just say it's between 10 and 20%. That's still really, really bad. Think about this. The car loan defaults right now are between 6 and 7%, and that's already making news about how that's the worst that it's been since the financial crisis 2007, 2008, 2009. So we're up between 10 and 20% now on personal bankruptcies. I think this should be front page news, and it's not a huge number yet, again, but any sort of increase where you see double digits, I think that should be something that should at least be discussed and looked at and talked about. In this article right here, out of payments, overdrafts add to consumers' financial burden as personal bankruptcies rise. But yet, we're told over and over again about how strong and resilient the U.S. consumer is. We're told how the U.S. we can afford to fund multiple wars when we can't even afford to fund the U.S. operations, let alone going around the world and funding wars. We have to borrow the money that we're using to fund these uh, everything. Basically, it's borrowed money. It's money conjured out of thin air, created into existence, basically at the click of a mouse. But yet everything's fine. There's nothing to worry about. No problems. Overdrafts add to consumer financial burden as bankruptcies rise here. Just to give you an excerpt here out of this article, significant share of consumers say they rely on overdrafts to meet short term financial needs, cover unexpected expenses, and maintain their purchasing power. However, this financial flexibility has come at a steep cost, not just for low income consumers, but for nearly 70% of high earners who spent more than they had in their accounts and were charged fees. So even high earners, 70% of high earners have gotten overdraft fees here in the past year. Again, everything's fine. The consumer's strong. Overall, 9 out of 10 survey respondents who struggle to cover charges to their accounts reported experiencing additional financial difficulties, while about 70% of overdrafts resulted in broader credit accessibility issues. And again, we're told that nothing's wrong, everything's fine, and nothing to see here. Well, the cost of living certainly isn't coming down. You may see a couple items here, a couple items there coming down. Gas up and down. It's kind of volatile with oil and gas. But overall, if you just average everything out, prices are still up versus last year. And remember, last year, in the middle of last year, we were up 8% over the prior year. So now we're up another 3 something percent on top of that. And that's just if you look at the CPI. Remember, the CPI doesn't really capture much of what U.S. citizens, consumers, actually consume or use or have to purchase. And remember, Paul Krugman came out, an economist, for the Times, and gave this inflation report saying the war on inflation is over. We won. But yet he didn't include housing, autos, or energy. So it was pretty much a joke. But people like that get put out there in the public eye as experts because they're not going to give you really the full picture on what's really happening. Why? Because the powers that be, they don't want people to realize, the true situation that most people are in, and you're just expected to sit back. And if you're in debt, you're expected to believe that you're the small fraction of the population and that everyone else is doing good except for you. They want to kind of keep you isolated in that thought. But the truth is, if you're in debt and struggling right now, you're in the large segment of the population, which is the majority of the population right now. But, they don't want you or the population at large to really know about that. Let's move on here to a little bit of a different topic here, but still strongly correlated to the cost of living, and that's strikes. We're seeing so many strikes now. Again, people not being able to keep up with the cost of living and demanding higher wages. Now, one of the biggest stories of the past year has been the auto workers strike, and there were fears that that was going to cause vehicle shortages and cause vehicle prices to start going back up. Luckily, prices corrected a little bit more in the past month. In a few days, we'll have the October numbers to report to you. But possibly good news for these auto workers. They have reached an agreement.
Carl, all three of the big three are now locked up into tentative agreements with the United Auto Workers. We have confirmed from sources that GM and the United Auto Workers have agreed to a tentative agreement, a 4.5 year contract. We have reached out to both GM as well as the UAW. Both have declined to comment, so we're waiting for exact details about this contract that has been reached between the two sides. Expected to generally come in line with what we saw from Ford and Stellantis, 25% raise over the next 4.5 years, over 30% when you add in cost of living adjustments, a number of other things in here that really, you have to look at this from the UAW perspective. This has turned out much better than I think people expected when all of this began back on September 15th.
Wow. So a 25, and they said even a 30% increase over the next few years if you factor in the cost of living adjustments. Well, I think they're going to have to adjust it up a lot more because the cost of living isn't coming down fast enough for most people to be able to escape this. And hopefully we'll see some of these other strikes that are happening come to a resolution. People do need more money. But worse than that, we just need to find um, a way to allow prices to correct to what people can actually afford. So instead of all these strikes demanding higher wages, we could avoid all of that, all of those strikes, all the demand for higher wages by just allowing the cost of living to correct. It's something called a free market, which nobody seems to think will work anymore. Well, let's at least try it because we haven't really even experimented or tried with the free market in over 100 years now, going back to when the central bank back in the early 1900s started doing this creation of money. Of course, 1971, everything was amplified since then because we came off of the gold standard. And ever since then, we've seen, if you look at a chart of inflation starting in the early 70s, it really started to ramp up. And if you look at here recently in the 2020s, it's really on a steep curve. I mean, I don't know how else to put it. It's gotten worse, just like we said here. Ever since this channel started, we said a lot of these things are going to get worse because no one's really talking about long term solutions. People are talking about short term fixes. Do you think this strike is going to fix anything for these workers? It may make things better over the next few years, but if we don't control the cost of living, they're going to be in the picket lines again in just a few years. Who knows? Maybe even before the end of 2024. We'll have to see. Touting this as it was a meal, it was a Big Mac meal, not just a sandwich. I haven't eaten a Big Mac in trying to think, maybe over 15 years. But not just that, it was just a particular location. One branch in Darien, Connecticut is charging as much as $18 for a Big Mac combo meal, which includes medium fries, medium soft drink. So people were exaggerating that a little bit, but the costs are up a lot for fast food, for all types of food. But I just wanted to kind of get to the bottom of that particular story for you because I saw a lot of people were actually reporting on that. And let's see what's being reported here. CFO Ian Borden confirmed the company's U.S. prices did increase in the third quarter. McDonald's expects to increase the cost of its menu items just over 10% for the full year, the second consecutive annual 10% price hike. There we go. Another example of how the official CPI number is absolutely nonsense. Wherever you look, it's more than 3%. Even looking at McDonald's is 10%, and they're saying another 10%. So 20% in 2 years. Crazy that people are still believing these official numbers that are coming out of the official sources. You know what I mean? People, here's what I think. We're headed into some really, really tough territory. And I've said this before, but I want to elaborate on this a little bit. I've never seen such a divide in the forecast and what people are expecting to happen or what think is going to happen. Half of the people seems like it's pretty evenly split. Half the people think there's going to be a mega crash, deflation, falling prices. The banks are going to tighten the lending so people won't be able to borrow money. They're going to drop credit card limits because the banks are in trouble. The other half thinks that it's inflationary, that the conflicts that we're seeing and just the financial collapse that we're seeing is going to be justification for dropping rates, helicopter money, liquidity injections, bailouts, stimulus checks, rescue programs, therefore highly inflationary, right? So you have this huge divide, huge split. And even personally, people that I talk to in my circle, I'm hearing so many different opinions, you know. So what do you think about this? Um, I'm starting to think that these conflicts are going to be used for emergency rate cuts, and massive liquidity injections. To me, that would be the worst case scenario. I would rather see a deflationary crash or correction. It's called correction for a reason. You ever heard of the term price correction? It's called correction for a reason because things are not correct. They're wrong. They're in a bubble. The cost of living is too high. Therefore, we need a correction, right? So things are not correct right now. They're wrong. Prices are way beyond what people can afford. Therefore, people have to go deeper and deeper into debt just to get by. Not just on even nationally, you look at the national deficits exploding, the budget deficit, and we need a correction. Right, so that would be the better of the two scenarios. So if banks tighten up lending, if we do see some sort of monetary sanity and see deflation, that would be better. It would still be very, very tough and difficult because deflation brings on a lot of problems. Again, I think better than an inflationary and especially better than a hyperinflationary scenario. But deflation brings on a lot of problems too. You have a lot of job losses. You have a lot of people that they find that their occupation is no longer relevant because some occupations rely on prices just going up and up and up. Just take a look at the housing market, right? So many people, realtors especially, are feeling the pinch and feeling the pain right now. Right, but let's get into a couple other articles here before we wrap this up here. And let's jump on over here to the housing market for just a couple minutes. Now, in just our previous video, we talked about how the housing bubble, it appears to have busted as prices are now down over 12% year over year. And prices just in the past month from August to September, we're still waiting for the October numbers, of course. Today's October 31st. Happy Halloween, by the way. But when the October numbers come out, will it be worse than what we saw from August to September, which was 3%, and annualized, we're down 3% year over year. So go back and watch that previous video. The housing bubble appears to have busted. But here's another piece of data here that I want us to consider here. Almost 60,000 home purchase agreements were canceled in August, making an increase of 14.3% from a year prior and the highest percentage since October 2022 when mortgage rates first rose above 7%. That's according to Redfin. All right, so more signs of distress in the housing market. The bankruptcies are up between 10 and 20%. That's personal bankruptcies. Corporate bankruptcies, even worse. Let me get you the latest number on those. We have, again, worsening here in the third quarter. U.S. corporate bankruptcies accelerated in the third quarter as 2023 is rivaling 2020. So we're rivaling the year of the great health crisis here, but there's no health crisis to blame this time. So what will the excuse be? It goes on here. The S&P Global Market Intelligence recorded 62 bankruptcy filings in September, bringing the total for the third quarter to 182, up from 157 during the second quarter. So another example of again, we're correct here. Things got worse from the second quarter to the third quarter. The second quarter was 157, third quarter was 182, and the fourth quarter probably over 200 new corporate bankruptcy filings. Before we're done here, we still have a couple months to go, of course. So, folks, fasten your seatbelt. Unless you think it's going to be safer to get thrown from the ride or thrown from the wreck, which in some cases can be a lifesaver. Pick your defense mechanism wisely. And, come back to this channel. Please give us a like if you like what we talk about here. What do you think about all the news today? The cost of the food, McDonald's saying up 10%, and another 10% is 20% in 2 years. But yet we're supposed to believe that 3.7% inflation is where we're at. What do we think about, as we open this report here, the personal bankruptcies up between 10 and 20%. Corporate bankruptcies, the worst since 2020. If you take out 2020, it's the worst in about 10 years, going all the way back to 2012-13. So we're not out of the woods, folks. In fact, I think things are just getting started. We haven't seen anything yet. This thing is accelerating. It's getting worse. And, hold on for the ride. And we're going to wrap this up. Like to hear from you down in the comments. Thanks to everyone for your support, especially the super thanks, folks. Let me give a quick shout out here to DJ Jojo. Hey, DJ, thank you very much for another round of support. Appreciate that. And also want to thank here, screen name here, Rose Black Goku 2023. Thank you very much for your support once again. Really appreciate it. And always thanks to everybody here. Again, please like, subscribe if you like what we talk about. The button is right down there. You see where my finger's at? So all you got to do is click that. You have to be signed in, and you can really help this channel out. Thank you very much, everybody. Bye for now. Keep stacking. Talk to you soon. Peace.